South African Airways has recently emerged as a debt-free entity, signaling a significant turnaround for the national carrier. However, during a session with Parliament's Standing Committee on Public Accounts, it was revealed that SAA requires a capital injection to restore its former prominence in the aviation industry. Now, this funding is crucial for advancing plans that have been delayed due to the absence of a proposed 3 billion rand investment from the Takatso Consortium. As discussions unfold regarding potential partnerships and loan facilities, SA's leadership emphasizes the importance of securing an equity partner to maintain competitiveness and facilitate growth in both regional and international markets. This morning, Sean Mendes, an aviation consultant, joins me. Thank you so much, Sean, for joining us on the show.
Thanks for having me.
All right, it's nice to have you around. So what specific plans would you say SAA has that actually required the proposed 3 billion rand capital injection? One, then how would this funding directly impact the airline's operational capabilities and growth trajectory?
Well, that's a good question. And I think, we need to lead into this just looking in terms of South African Airways' financial history in this respect. And, the airline entered into business rescue, which is basically a bankruptcy restructuring process in 2019. It emerged from that a couple of years ago and restarted operations. During that period, the government of South Africa gave them bailouts of 38.1 billion rand. So that is in the range of anything between 2 and 4 billion US dollars, depending on the exchange rate at the time. So, when you're looking in terms of saying that they're now debt-free, that debt-free has come on the back of the South African taxpayer. Now, together with that, this is an airline which has not presented its latest financial statements publicly. They are having a dispute with auditors over the audited financial statements. So any statements in terms of saying that they are debt-free should be taken with a bit of a pinch of salt until there's actually audited financial statements to back that up. But that said, obviously, following their business rescue emergence, they have a relatively blank sheet of paper upon which they need to build. And unfortunately, while that has discharged the debt, it has not come with recapitalization. The intention in business rescue was for the government to sell a stake to a private partner, and that, as you mentioned, was the Takatso Consortium. That deal collapsed. And now, while the airline is funding its activities out of cash flow, it does not have the capital available for any expansion, fleet renewal, or any other requirements, going forward. So I think that is what SAA intends to do with the capital that they might raise, whether that's going to be in terms of an equity partner, whether that's going to be coming in terms of debt from elsewhere. That is what really needs to be determined.
So it seems as though SAA is at a crossroad. I mean, from the way that I'm seeing it, having to look for an equity partner to recapitalize its business. Now, if Takatso Consortium might be stalling on that 3 billion rand, how do you think SAA will now be able to float and thrive and probably, compete?
SAA can't compete without some sort of capital access. And I think the key question here is, how are they going to get access to that capital? Because, they've got a fleet which is aging. They've got a fleet which, their Airbus 340 aircraft, which they're using for their intercontinental flights, for example. I mean, these aircraft are 20 years and older. Even their Airbus 320s, these are leased aircraft, which are secondhand, which are older. And this is not something that's going to allow them to increase their operations and grow back to at least a critical mass similar to what they had before. So it's going to be important for them. But the problem they have is obviously, as a government-owned airline, it's not as though management have a say in terms of how they will raise this funding. That is going to rest entirely in the hands of the shareholder, which is the government. And now, once again, back with the Department of Transport after a spell with the Department of Public Enterprises under the previous administration. So it's a tricky situation for management at SAA. They need money, but they don't have the ability to go out and necessarily raise money through, say, sale of equity, all they can really do is explore the possibilities for, debt financing.
So is it possible for SAA, in terms of its capacity, to probably try and secure maybe loan facilities from, I don't know, any company or consortium that might be able to provide that, since Takatso seems not to be coming to the table? And of course, does it have that wherewithal to actually attract FDI? Maybe some foreign investor could or might be wanting to put their money into that particular entity. Is it possible?
Well, there's multiple issues over there. So let's address the Takatso issue first. The main thing was that it was not Takatso that pulled out of it initially. It was the government of South Africa that pulled out of the deal with Takatso. Now, ostensibly, they said that was because the initial valuation agreed with Takatso had now inflated. So the company was worth more than when they first reached the agreement 2.5 years prior to that. And consequently, they felt they were not getting a good deal. But, again, you have to look in terms of the fact that when the option to a bad valuation is zero, was that a smart idea? Well, that's for the shareholders to make that assessment. The next point is foreign investment. And the problem with foreign investment is that South African laws restrict the amount of foreign investment that can be entered into an airline company to basically 25%. Everything else must be owned and controlled by citizens and residents of South Africa. So once again, if there's going to be a foreign investment in this, it's going to have to come from someone willing to take a minority position and for the control to remain with the government of South Africa or other South African shareholders. Okay. Finally, we come down to the options of debt. And debt is something that, they have addressed. Their CEO made a statement that South African Airways has about 5.5 billion rand of real estate. And they're looking to try and have some sort of a credit facility or a loan facility set up secured by that real estate, which would at least give them access to working capital in an emergency or any other, strategic need situation where they needed additional cash flow. So that essentially is where they are at this point.
Okay, I think that would actually, come into play and help them have some economic buffers, of course, to stay in operation. A couple of people have come out to say that, aside that, why is it that it seems as though the South African government, or should I say the Treasury, didn't factor this in at the initial stage when they were making over 38 billion, like you said, available to have this entity offset its debts? I mean, that would have given it the opportunity, to re-strategize at that point and to seamlessly transit from a debt-prone entity into a debt-free entity and continue to, continue with its operations. So would you say that the plans to help SAA stay airworthy has been seamless? Would you say it has been incredible and fantastic? Or probably there are some other areas that the Treasury or the South African government didn't consider before rolling with this plan?
I think it is absolutely the latter case. This has been a completely bungled situation. The government basically put themselves in a situation where they wrote a blank check when they insisted that the airline had to emerge from its business rescue process as a continuing business entity. The smart situation from the government may have been to let the airline go under and then explore the possibility of either private sector or a new government-backed airline, taking over. But by continuing with this, they've taken on a lot of liabilities for the South African taxpayer, and consequently, they basically put South African Airways and its new management team in a situation where they have to fight with one hand tied behind its back, where they're unable to go to the market to raise capitalization. They're stuck with outdated assets. They're stuck with debts, liabilities. For example, they have unflown ticket liabilities. The tickets that South African Airways sold prior to entering into business rescue remain liabilities on the books to the new South African Airways, and those have to either be paid off once again by the taxpayer, or the new South African Airways basically has to fly passengers for funds that the old South African Airways took on. So I think this has been something which has been very poorly thought out by the government of South Africa, and I think the government of South Africa isn't a single entity. There are definitely differences within cabinet in South Africa as well, where the former minister in charge, the late Pravin Gordhan, was very clear in terms of what his vision for this was, while, other ministers within cabinet, say from the Treasury, who had to actually finance some of these programs, had different views. So, as I said, it's not the fault of management. Management are doing the best they can in a bad situation, but I think the shareholder and in general the government of South Africa has not had a coherent strategy about the aviation sector, and consequently South African Airways has paid the price.
Okay, all right. Well, since emerging from business rescue now, what are the key performance indicators that SAA rather that you would say SAA should be focusing on in terms of when we talk about probably measuring its recovery and growth plan? And how do you think those indicators should or would align with the airline's long-term vision?
Well, I think the main change in their business strategy after emerging for business rescue has been a focus on becoming a stronger regional and domestic player. In the past, South African Airways had a fleet of long-haul aircraft flying to Europe, North America, and all over the world. Right now, they have a very limited fleet of aircraft capable of doing those routes. So they are only flying intercontinental to Brazil and to Perth in Australia, both of which, when they launched those routes, were markets where they had a monopoly and consequently were probably very wise choices, judging by the results that those markets had given them. The rest of their fleet is deployed on routes within Africa, whether that's domestic, regional, and semi-regional to West Africa, where they fly to Accra and Lagos using the wide-body aircraft. And I think it's a smart way of going, because this is where the growth is, this is where the higher yields are, and this is where, if they're looking at trying to obtain operational profitability, which they have to, because right now, without access to working capital, they have to fund all their operations through cash flow. So they have to choose smartly and pick routes upon which they can at least sustain their operations on the basis of cash flow. But as I mentioned before, it puts them in positions where they have to take decisions based on short-term outcomes and not a long-term strategic view. And I think that's a very difficult situation for any management team to be in when you're looking at maximizing long-term value, but having to do that with short-term decision making.
Well, it's quite interesting that we're talking about a national carrier that a lot of people thought would be a financial asset to the government, but then has been a liability. And of course, it's a stiff competition because we have Mango Airlines and some other airlines flying within the South African airspace. So, I mean, SAA will need to watch it still at this point if it hopes to stay in business. Sean Mendes, aviation consultant, it was nice talking to you. Thank you so much for your time.